To me, it just seemed like this crypto ball held right before Trump's inauguration had the same potential to become sort of the symbol of whatever is about to happen next in capitalism and markets. The pro is that crypto, in theory, could turn out to be this incredible innovation that democratizes access to capital, and the con is that it could also just become this symbol of anything goes capitalism that is, kind of cynical. We've had the Trump token, which is like basically a tokenized way to bribe the president, and the Trump token is a way to pay the president, a little bit indirectly, and especially a way for foreigners or foreign entities to pay the president. It's just basically the same as handing a bag of money to the president of the United States, which normally would not be allowed, but crypto enables that.
Byron Gilliam is market strategist at Blockworks, where he writes a daily newsletter translating complex crypto and macroeconomic trends for investors.
Prior to joining Blockworks, he spent 25 years trading international equities for major banks and brokers in Frankfurt, London, Paris, and New York.
As a token holder, you have no legal claim on either future earnings or a protocol's assets. For me, there's a lot of value in a protocol proving this social claim, and the way to prove that is to...
How would you argue against this and make the case for it not being a security in a traditional sense?
Yeah, that's a hard one. Yeah, that's a good question. What's different about crypto? It's looking increasingly like it's just a regulatory arbitrage. They're just securities with no rules. But I think there is a genuine difference, and I think it's what we were just talking about. But when you get into crypto, you have to rethink everything. Is this a security? Does this have a claim on assets? Why is this thing worth anything? And that's what makes it fun.
Is crypto an investable asset class already?
Personally, I have a strict definition of investable. My definition of investable is that...
Hey guys, welcome back to Less Noise, More Signal. Yet another great show that we will have today, I'm sure. We have Byron with us. I think you are a writer for Blockworks, is that right? Maybe you can quickly introduce yourself.
That's correct. I write a daily newsletter for Blockworks covering crypto and business and markets.
It's a daily newsletter, so you write a piece every day.
5 days a week, yes.
Okay, yeah. Except probably on weekends.
They do let me have weekends off, which is very generous of them.
Yeah. I mean, crypto is 24/7, I guess. After all,
that's
but
right.
maybe
In theory, it should be every single day because the market is always open. We do send newsletters on Christmas and Thanksgiving because crypto is trading. So
yeah, no, that's crazy. I mean, technically, I sometimes feel like, wow, that's so interesting. But then at the same time, if I because I do work at the bank as well, and then obviously we're discussing these things as well internally. Are we going to move to products that will incorporate Bitcoin maybe on the credit side, and then all the questions usually come, well, then I have to work on weekends to monitor everything. So I mean, probably there's also software that can help you do this, but still, I mean, some change might still be coming our way. We'll see how that will turn out.
It's a mixed blessing.
Yeah, exactly. Well, cool. No, it's amazing to have you on today. I mean, I needed to bring you on because of a recent piece from that newsletter that you referenced that I read, and it was called "The Age of the Junk Equity," and this really, resonated with me. I really liked the idea. I was just intrigued by also the sort of historical comparisons that you made to the junk bond industry, and then it was around I think when you published this, when this infamous crypto ball also happened. And so maybe if you could quickly summarize the article, your thesis, and just your takeaways for the audience, that would be great.
I wrote that one just after the crypto ball, which was only a few months ago, but it seems like it was, 10 years ago at least by now. That was held I think the Friday before inauguration, so the beginning of November. And it was when all of the big crypto donors to the Trump campaign were invited for an inauguration party, of which there are lots of them before every inauguration. And it just seemed very reminiscent to me of the Predator's Ball, maybe just because of the name, like the crypto ball, the Predator's Ball. But the Predator's Ball was an iconic thing from the 1980s. It was held by Michael Milken, who invented junk bonds. And once a year, he invited all of his junk bond customers to Los Angeles for what started out as a conference, and then kind of, as junk bonds got bigger, kind of turned into more of a big party. And that became sort of the symbol of 1980s capitalism and 1980s stock market excess. And to me, it just seemed like this crypto ball held right before Trump's inauguration had the same potential to become sort of the symbol of whatever is about to happen next in capitalism and markets.
Mm. Yeah, I really like this comparison because obviously I wasn't around back then, in the 1980s when
I,
the
I,
junk.
I was, unfortunately.
Okay, I see. And that's also what I sort of felt when I read the article, because it felt like, okay, um, with the emergence of the junk bond industry, I mean, they were sort of struggling with some of the same problems, we as digital asset investors are struggling with today, that like a lot of people are really disappointed in what's happening, and they're really calling for hope, and or is this thing doing anything at all, and so it felt to me that maybe some of the same things were happening back then, and some of the same criticism was also leveled at this the junk bond industry. But nowadays, I mean, the junk bonds, maybe some people are still skeptically looking at it, but it's now a established sort of branch within financial markets. And so, is that sort of a fair comparison if we compare it back to the
Hmm.
junk bond industry, how it was treated?
Yeah, it's definitely a fair comparison, and I think it can be a hopeful comparison, and also a whatever the opposite of hopeful is, despairing comparison, I guess. Um, because on the one hand, junk bonds turned out to be an incredible innovation for the economy. Democratized access to capital. It made the U.S. economy far more efficient. It started industries that wouldn't have started otherwise. It's part of what has made the U.S. economy more dynamic than its developed world competitors. But despite all that, it also became a symbol of anything goes capitalism, in part simply just because of the amount of money that people made, and Michael Milken in particular. Michael Milken I think he made like $500 million in 1988 or something like that. It was like, and it was in the same exact year that he got arrested for insider trading. And $500 million at the time was just absolutely unheard of. Like, nobody had ever made that much money. Um,
Yeah.
and then he got caught up in all of these insider trading things, which made it seem like all of it, made it seem like the whole thing was a scam, which it wasn't. I don't even think he was guilty of insider trading personally.
Yeah.
Um, so there's the pro and the con. The pro is that crypto, in theory, could turn out to be this incredible innovation that democratizes access to capital. And the con is that it could also just become this symbol of anything goes capitalism that is kind of cynical. I guess the difference from my mind so far is that the crypto ball was sort of had more of a cynical take. Actually, that's not true. I think the crypto ball, like everyone at the crypto ball, I think means very well. Um, but already just 3 months later or whatever, it's feeling very cynical. Like, we've had the Trump token, which is like basically a tokenized way to bribe the president. We've got World Liberty Financial, which is another way just to for foreigners in particular to funnel money to the president's family. We've got the World Liberty Financial stable coin, which is basically the president collecting seigniorage on the currency that his own government issues. And then we've got this like crazy Trump dinner where whoever holds the most Trump gets to meet the president. Like, that stuff is all just just very cynical, I think, in a way that junk bonds were not. That was the perception of junk bonds, but the reality of the junk bonds were more substantial than that. And I think, crypto still has absolutely the potential to do something substantial in the way that junk bonds did. But, just in the last few months, it's getting this very, cynical version of capitalism, which was also the perspective of junk bonds in the 1980s, I think.
Yeah. No, it's just interesting to my mind. I mean, there are these sort of ironic and eerie, like parallels between these two things. Because one thing that you even alluded to, I think, in the piece is that this Mr. Malcolm that you were, Malcolm, right? Is his name? The guy that you were referencing, Malcolm, that you were referencing, he was then sort of also pardoned later, in 2020, I guess. And it was done by Trump himself, I think
Yes,
probably
I love that. That is just very, it's
eh,
very poetic. You couldn't
yeah,
make it up.
yeah, and so there are all these sort of uncanny connections and
And
parallels
also,
that
and
sort of.
and rightly pardoned. I think it was totally justified.
No, but yeah, it's just interesting that I mean, because that's usually the argument, that's being made against crypto. It's like, oh, it's this anything goes capitalism that is now kicked off. We've never seen something like this in our lifetime, and especially for somebody like me who's younger, who's not been around like earlier. I mean, it feels like okay, maybe this time is really different, and it's to an extent that it has never happened, and maybe in some aspects this is true, because crypto is sort of global and is maybe even more hyper financializing everything sort of, but at the same time, if you then sort of take a step back and as you did with your piece, give some perspective, feels like there's been other episodes in human history, and even in recent human history where things haven't been that much different. I read another article about back in Roman times, when there was like something similar going on to meme coin trading, and even the Romans were sort of intrigued by these things just because it's probably appealing to human nature in some sort of way, and so my point is probably, yeah, human nature is always the thing, and stuff is the same, and things just rhyme and they come on over and over again, right? Just in maybe new forms, so to say.
Yeah, one thing about finance is that there's a Jim Grant quote, the financial journalist Jim Grant. He's got a quote about how knowledge is cumulative in science, but it's cyclical in finance. So, which is to say, we have to relearn every lesson in finance like every 20 or 30 years. And if you read financial history, you read about like the Panic of 1893, or the things that used to trade on Lombard Street in the UK in the 17th century. Like, it's just all the same behavioral finance stuff, and it just happens over and over again.
Mm. Yeah, that's a great quote. One sentence that stuck with me that you just said a while before was like this: the Trump coin was sort of a way to tokenize, or tokenizing a way to bribe the president. That's something I've never heard. Can you
Yeah,
maybe
yeah,
elaborate on this? What
so,
you mean exactly, and in what way was he being bribed? Through that token, like.
yeah, I like calling it tokenized emoluments. Emoluments are disallowed by the Constitution. Even the founding fathers were aware that you had to have a law that said that people could not just pay the president, because that would obviously be a conflict of interest. Um, and the Trump token is a way to pay the president, a little bit indirectly, and especially a way for foreigners or foreign entities to pay the president. There are campaign finance laws that say foreign entities and foreign citizens can't contribute to campaigns. Um, and the Trump token is a way for them not just to contribute to the campaign, but to contribute to the president directly. It's just basically just the same as handing a bag of money to the president of the United States, which normally would not be allowed, but crypto enables that.
This show is brought to you by New Hedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL. Yeah. I mean, now that you say it, I can't pinpoint to what exactly happened there, but one example that would come to mind is really like Justin's son. He was also sort of said to be an investor in World Liberty coin, and then they were probably in Trump coin as well, because people are speculating, because there's like this address and it has this acronym to it, SUN, son.
Yes.
So people speculate that it might be him who wants to go and have a seat at this table. But then I think when this happened a few days later, I think it wasn't some of his projects then like SEC withdraw some sort of fight that they had going on with him?
They dropped their cases with Justin Sun. I actually think that those things are probably not related, only because the SEC dropped their crypto cases against everybody. So like, you didn't actually have to bribe anyone, because
Make the connection,
all crypto cases were being dropped. So I don't think that there's a direct connection between those two things. But I mean, clearly, Justin Sun has got the ear of the Trump family, maybe not the president directly, but his sons at least. He sits on the board of World Liberty Financial now. So it's impossible to not at least suspect that people are buying themselves some influence via crypto.
Yeah, again, it's just an uncanny connection there that you that sort of invites you to speculate about these things. So that's for sure. But you said about the junk bond industry, that there's some more fundamental to it or fundamentals to it, and so my question would sort of be, some people would argue with crypto that's not the same. It's still like missing any sorts of fundamentals, because like with junk bond. Junk bonds, there was at least a company behind it. And so now what is it with crypto? It's just these protocols most of the time. So how is your way of sort of going about and thinking about how to value these junk equity, or these pseudo equities? Is there any sort of way that you have that you do this, or?
I mean, I don't. Yeah. It depends on the kind of token, I think. But the underlying question is like, why do these have any value at all? Very few of them have any sort of rights, and if they do have rights, then they can only be in the smart contracts, right? Like there's no crypto tokens don't have any legal claim on assets or cash flows like a stock would do. So if there is any claim in quotation marks, it has to either be written into the smart contracts, which it rarely is, or it has to be a social claim, which is very fuzzy and indistinct. But I think it's real. I think social claims on earnings can have real value. And the way to measure that for me is just to look at to what degree a protocol is returning revenue to its token holders. So there's a big debate in crypto about whether protocols should be returning revenue at all, or there used to be a debate whether protocols should even be trying to make revenue, and I think that's been resolved in the direction of yes, they should be trying to make revenue, because otherwise the whole thing is unsustainable. And then there's a separate debate about if they are making revenue, should they be returning it to token holders? Most people in crypto take the view that they should not, because they look at protocols as startup companies, and you would never expect a startup to return revenue to equity holders. You would expect them to invest that revenue in growing the business, and that's what most crypto people want protocols to do. They want them to make revenue and then reinvest it in the business. But from my perspective, since as a token holder, you have no legal claim on either future earnings or a protocol's assets, for me, there's a lot of value in a protocol proving this social claim. And the way to prove that is to immediately start returning revenue to token holders. My favorite form of tokenomics in crypto is the DeFi model, the DePIN model, where a lot of the DePIN projects are simultaneously buying and selling their tokens. So they when they make revenue, they automatically turn around and use the revenue to buy back tokens. But at the same time, they are issuing tokens to, either cover expenses or to incentivize suppliers. And that you would never do that with a stock. Like, it just doesn't make any sense to be simultaneously buying back and issuing equity. But in crypto, I think it does make sense because it proves that token holders have this social claim on earnings.
When you talk of social claim, I mean, is this in juxtaposition to something like a legal claim that you have with equities? Is that really a fair way to say it? Because with equities, you have this legal claim. And even though in some sense, like a company is not forced to pay any dividends, I think at least that's how I understand it. There's still sort of, if you are a shareholder of a company, you own the company, or at least that's the feeling sort of that people have. And then, but there is some legal contract there. And is that opposed to with a social claim, there is no legal sort of contract, but then the social, it just arises out of sort of a social contract with your holders? Or how can we make sense of these two things, and like a social claim and a legal claim, sort of?
Yeah, that's exactly it. You don't, if you own a stock, you don't technically own the company. Like, buying a few shares of Apple is not going to get you a key card that's going to get you into the headquarters in Palo Alto or wherever it is. But you effectively own the company. And like you said, you can't demand a dividend. Management is going to decide whether it's going to pay a dividend or not. But if Apple sold itself to private equity, which obviously would not happen, so that's a bad example. But in theory, if Apple sold itself, then and you own 1% of Apple, then you would get 1% of the proceeds, right? So in that sense, you have a claim on the asset and the value of the company. But you don't have that in crypto. Like, if a crypto protocol sold itself, then token holders wouldn't have any claim on the proceeds. But I think in most cases, probably all cases, the protocol would do the right thing and pay out the proceeds, according to how many tokens you have. But that would not be able, you wouldn't be able to enforce that in court. You would have to enforce it in the court of public opinion on crypto Twitter and stuff like that.
No, I see. The question that I'm having is just like, is it needed that at some point, there will be some sort of legal basis for such a social claim to evolve, or could it evolve without any legal basis or a legal claim even, to the underlyings? Because that's really the question that I'm having, because you had this other example in one of the articles where you spoke of Berkshire Hathaway, the company famously scaled up by Warren Buffett, and obviously you said they paid the dividend only once in history, I think in 1967 or something, and they never did it again. But even there, I mean, there's a social claim that now the company grew, it reinvested, people sort of felt, okay, it's good for the stock itself, and but there was this legal basis still, I'd argue. And again, with most protocols as of now, there is no legal basis. And do you think this needs to be changed, and there will have to be a legal basis for such a legal claim to really at scale emerge? Or could it emerge without it, over time, and it just takes time, sort of?
Yeah, no, I don't think there has to be a legal claim. I think if there was a legal claim, then it wouldn't be crypto anymore. They would just be equities. They would be securities, and it would just be, we would have just reinvented the stock market, which is not what we're trying to do. We're trying to reinvent a new version of the stock market. And if you gave tokens legal claims, then they would just be stocks, right? So yeah, so I don't think it's necessary. Like I think the social claim on revenues is already, evident in lots of cases. And I think that enough for people to invest and for token holders eventually to be rewarded if crypto protocols do genuinely start creating value.
Mm. What is your arguments against people who are arguing, okay, like crypto people in and of themselves within the industry really feel like they're building something new here, like it's distinct from the traditional equity markets, and so yeah, it has to be treated differently also legally. And then you have all the cynics, you have like the people from outside of crypto, then you have all the Bitcoin maxis, who are throwing like bad apples at all these people, saying, okay, what you're doing here is just disguised as securities. Like most famously, Michael Saylor, he's also like, Bitcoin is this commodity, everything else is a digital security. And so what is your counter argument? Why are these things not a security? And it's probably not as clear cut, because a lot of things, yeah, there are some developers and it's not like a company, but at the same time, there's a foundation and still some structures. And so it's probably hard to distinguish, but how would you argue against this and make the case for it not being a security in a traditional sense, so to say?
Yeah, that's a hard one. Yeah, that's a good question. Like, what's different about crypto? When I started writing about crypto 4 years ago, I didn't know that much about it before I started writing about it. Um, uh, and at that time, there was more of a sense that protocols are not companies, and tokens are not stocks, and that you couldn't own a protocol. Like a protocol is just software and nobody could own it. And a lot of people believe that the protocols shouldn't even be attempting to make revenue. And if they did make revenue, they definitely should not be returning it to token holders. Like everything should be a governance token. Um, and as soon as you start returning revenue to token holders, then you're just a security. And that's changed over the years. Like that's now people, protocols are very upfront about saying like, this is the way we're going to make revenue and this is the way that we're going to return it to token holders. You didn't used to see that 4 years ago. Like 4 years ago, you would look at you could still go back and look at the Uniswap website, and they, went out of their way to say that like we're not going to try to make revenue and we're not going to try to give it to token holders. They were obviously advised by a lawyer, like this is the way you avoid being a security. And now that's totally changed. Now, the investors are looking at it in a much more traditional sense of they expect protocols to make money and they expect to have a claim on that money. And then that raises the question that you've just asked, like, well, what's different about crypto tokens then? And it's probably getting harder to answer that question. It's looking increasingly like it's just a regulatory arbitrage. They're just securities with no rules. But I think there is a genuine difference. And I think it's what we were just talking about. Like you really do not have a legal claim of on assets or cash flows. I think that's the essential difference. And then you could get into the Howey test and say like, there's no, managerial effort. There's no, protocols still don't have CEOs and stuff like that. But I think the core difference is that you don't have a legal claim. You're not genuinely an owner. And protocols at the end of the day are still just software and not corporations.
Yeah, it's a really tough one, as you say, because in the end, a lot of these things, it just comes down that it doesn't exist, like the legal basis, and that it's not called a CEO. But the fact is, sometimes even if it's not called like that, maybe in reality it is actually a CEO, and it's just he's not calling himself a CEO. So I think that's sort of the hard thing, and obviously we're probably in the process of figuring this out. After all, I mean, you could argue in the early days, and maybe still some people would argue with Bitcoin, it's the same, because like decentralization, obviously it's a spectrum, it's always a continuum, and it's never like, okay, now it's decentralized enough, or it's really hard. It's also subjective in some sense. So probably further down the line, I hope, that's at least my hope, that we will sort of, it will make itself shown, that okay, these things are now sufficiently enough decentralized, and sort of they are really different than a actual company. But it's probably one of the hardest questions after all.
Yeah, I think that's what Hester Pierce is working on, right? Like, I think
Mm,
she's working on a roadmap for protocols to say, like, okay, when you start, you do not have to be decentralized, but within 3 years or something, you need to show that you've made some progress, at least made some progress in that direction. I have no idea how they're going to measure
mm,
that, and why the SEC thinks that they would be able to determine what's decentralized and not decentralized, but they're trying at least.
mm. Yeah, exactly. No, it's just that we are in this weird spot, whereas, like, yeah, we call ourselves something different in crypto, but then at the same time, we also want to distribute like sort of revenue and stuff, and then because there's revenue, there's a business, and then again, isn't that sort of close to how things are done in the traditional world, and even with these valuation metrics nowadays, like that's also something when we go back to the investors, like, okay, how do I value these different projects, and then you're like, okay, maybe you use a discounted cash flow method, and no, you do something else, you draw from the traditional world, take a valuation metric, and then some people are like, no, that doesn't make sense because blockchains and then also applications on top of blockchains, there's something completely different, and that's why it doesn't work in the end. And so, yeah, I mean, we're really still in the process, but of figuring this out. But I think what's really interesting is also, and you said that it's one of your pieces as well. I mean, with traditional stock markets way back in time, it wasn't that different in the beginnings, and it took hundreds of years before like these valuation metrics were finally established. And then nowadays we take them for granted. But I think that's what I loved about this other piece. It's that you said this wasn't built in one day. So Rome, and that's correct, right? In the after.
Yeah, but this is what makes crypto fun and interesting to me, is that, we're reinventing finance, which forces you to think about everything from first principles. Like, I was a trader at investment banks and brokers for 25 years, and I never once heard of the Howey test. Like, if you're trading a stock for a bank, you don't think like, is this a security or not a security? Like, you don't have to think about these things. But when you get into crypto, you have to rethink everything. Like, is this a security? Does this have a claim on assets? Like, why is this thing worth anything? And that's what makes it fun. And in my newsletter, I do like to go back and draw a lot of historical parallels, just because I think that they're interesting. I think the one you were referring to was when I was writing about the Curb exchange recently, which I thought was a really fun one. So before this New York Stock Exchange existed, the exchange was literally just people standing in the street. And then the exchange got a little more formalized and it moved inside. But a lot of the traders deliberately stayed outside where there were no rules. And that was the Curb exchange, or the Curb market. And anybody could walk up and trade a stock. Anybody could walk up and offer a stock. And that's basically what crypto is, right? And there were like a lot of interesting things that came out of the Curb market. Like, it funded a lot of the gold rush in the 1840s. It funded a lot of the startup oil companies, spin-offs from Standard Oil. Woolworths, I think, was one that got its start on the Curb exchange. I think there were a few other famous ones, like maybe Pepsi or something like that. I've forgotten now exactly. But that's kind of the hope for crypto. It's like this no rules market, and hopefully some like interesting and experimental things will emerge from it.
Yeah, for sure. I don't know if it's related, but in some of your pieces, you also wrote about this very sentence: "Crypto protocols need their Gordon Gekko moment." Can you maybe elaborate again for people? I mean, it probably rings a bell, the name, but most of the people don't really know what he's famous for, and then also how is it related to crypto in any meaningful way?
Yeah, that's me showing my age. Gordon Gekko was the main character from the movie Wall Street from the 1980s. and Wall Street, the movie, became like the symbol of 1980s capitalism and Wall Street skullduggery, insider trading, and buying companies to break them up and fire all the employees and stuff like that. And Gordon Gekko was the corporate raider, modeled on like KKR, somebody like that. And his most famous line is "Greed is good." But that's not the line that I'm referring to there in the same speech. So Gordon Gekko is this corporate raider, and he attends a shareholder meeting of Teldar Paper, which is a make-believe company. But it's like sort of a 1970s style, sleepy American company where the executives were not, interested in helping shareholders. They were just interested in their 3 martini lunches and using the corporate jet to fly to their weekend golf outings and stuff like that. And that's basically what American capitalism was in like the 1960s and 70s. There was not very much regard for shareholders. Shareholders were not treated as if they owned the company. Executives kind of ran the company in their own interest. And the Gordon Gekko moment was in real life. The Gordon Gekko moment was was KKR's leveraged buyout of RJR Nabisco, which was this huge tobacco and food company that was run very sloppily by executives who were mostly who were not interested in treating shareholders as owners. And the Gordon Gekko moment is, in the late 1980s, shareholders genuinely started being treated as owners because of the threat of the real life versions of Gordon Gekko's. If you ran a company like RJR Nabisco was run, then a corporate raider would come in and take it over. So in the movie Wall Street, Gordon Gekko tells the shareholders of Teldar Paper that you own the company, which is like maybe not technically true. But in the late 1980s, the big revolution was the revolution of shareholder rights, after which since which shareholders have been treated as if they own the company. And I think that crypto token holders need to be treated the same way. So that would be the Gordon Gekko moment. If token holders are treated as if they own the protocols that they buy the tokens of, whether or not they do technically.
Okay, I see. Yeah, that makes a lot of sense. I mean, in the end, it goes back to the same question again. If then, like, sort of the crypto protocols themselves establish this, and then they like go outright say, okay, you are now, all the holders are sort of now the actual owners, then they sort of create this attack vector again, for regulators to come after them in some sort of way, maybe. And so, to me, it really all feels like a chicken egg problem. But yeah, we will probably find some way to figure this out as we go along. So yeah, it's just very interesting because it's, as you elaborated, it worked out in the past as well. I mean, what I wanted to ask you because of this, because like, the social claim with all these protocols, it might not be where it should be, not as established. And then also the valuation metrics that maybe some people are still struggling with. So, I mean, I do understand if some people who are professionals look at digital assets and say, well, I don't want to cover this because, yeah, it's nothing tangible. Again, I can't really measure it. And so my question would be, is crypto an investable asset class already? What would you say?
I think it's getting more investable. I personally have a strict definition of investable. So, my definition of investable is that you need to be able to buy something and make your money back, plus a risk-adjusted return on top of that without ever selling it, right? So if you can buy a stock and it pays enough dividends over time or buys back enough stock, returns enough capital to investors, that you can make a return without having to sell it, that to me is an investment. If you buy something and the only way that you can make a return is if somebody else chooses to pay more for it, then that's not an investment, that's a trade, right? So gold to me is a trade because, it doesn't pay a yield, and the only way you're ever going to make money on gold is if somebody in the future chooses to pay more for it. So that to me is a trade. It's been a trade for thousands of years now, so maybe it's reached escape velocity, and maybe that's an investable asset class now. But by my definition, gold is a trade, and then obviously Bitcoin is a trade then as well, because the only way for you to make money in Bitcoin is for somebody else to pay more for it, and that to me is not investing. That's trading. But there are increasingly crypto tokens that are making money and are returning the money to token holders. So in that sense, it's getting more and more investable, as of recently in particular.
Yeah, I see. That also to me then means that it has to have some sort of sustainable business model where it actually creates these revenues and it's going to be successful and sustainable, because obviously already back in 2020, 2021, we had that, with like the whole staking craze and the whole DeFi where you could do sort of stake your tokens and then you were sort of getting a return. But I mean, your tokens were all just inflated away. So maybe the return that you got was then all abstracted away or like siphoned away because of the inflation that happened. You
Yeah,
got
that
token.
was more of a Ponzi return,
Yeah,
not as
exactly. And
opposed
so
to a real return.
that can't be the case either. So, I mean, yeah, because I really feel that this distinction that you make between the trade and something which is investable resonates a lot with me, because that's also what I figured out over the years now, to make this distinction between a really important distinction in my mind between the crypto for traders, crypto for traders and then crypto for investors, and I think lots of time with normal people, this just gets conflated, and they just loosely speak of, yeah, I'm an investor, but actually you are a trader, because like trading crypto can be quite profitable, I guess, if you know how to, because of the great volatility and the asymmetries and everything inefficiencies. But then investing, and that's what most of my friends, when they buy crypto, which are not like that exposed to the industry, they're just like, I buy this for the longer term, and that's probably what we figured out so far, especially when you then compare it only to Bitcoin, for example, the prime digital asset. You weren't able to outperform it. So maybe that's also an important distinction that we have to make. And unless something changes, and these things actually become investable, closer to your definition, then it makes sense to speak of crypto also for investors, I guess. Is that sort of a fair
Yeah,
judgment?
I agree with that. I would say that the distinction to keep in mind is that just because you hold something for a long time, that doesn't make an investment. Like the holding period is not what makes something an investment or a trade. If you hold something for a long time, but you're still dependent on somebody just choosing to pay more for it, then that's still a trade. It's just a longer term trade.
Mm-hmm. Yeah, no, makes sense. Well, I mean, I have one more question to sum everything up and then come to a close. But I mean, given that what we've talked about, there's still a lot of unknowns, and the industry as such is struggling, to really find its footing and bearing. And so the question to me is, what then really explains crypto's appeal? Because after all, there is a great like. Like gravitational pull towards this new industry? Is it just because it's new, or to what extent is there this gravitational pull, and why is it there? I think you had this one article where you talked about the DIY finance, do your own research finance, I guess. And there, I think you sort of alluded to some of the answers to this question, but if you could share your thoughts on why is there still such an appeal, even though it seems to be struggling, that would be great.
Yeah, it's a good question. And I think there's a few different ways to answer it. One is just that, casinos are still popular, right? Like, people have been losing money in casinos for millennia, and they're probably more popular than ever now, right? Like sports betting is incredibly popular, even though anybody who's bets on sports knows that it's a bad idea. But it's fun, so people keep doing it, and I think crypto is fun, so that's one reason. Um, Another reason is the appeal of lottery tickets. Like everybody knows that buying lottery tickets is a bad idea, but crypto has a history of things going up 1,000x or 10,000x. So people are hoping there's going to be more of those. I'm not sure that there are going to be. I think that's probably behind us now. That era of finding things that are going to be up 1,000 or 10,000x. But that's another reason people love lottery tickets. More substantially, I think that crypto is a financial system with no guardrails. And that is, one, it's fun, but two, it can be important. There's been a real decline in IPOs in the US over the last, couple of decades. When I was a trader in the 90s, it felt like there were multiple IPOs every single day. Now there's, I don't know, a few IPOs a year or something like that. And there are, very few IPOs of small companies. I saw a statistic the other day. I think that if I'm getting this right, I think since 2018, there have only been 2 companies in the US that have IPO'd with less than $100 million of revenue, which to me is kind of pathetic. That's like, traditional finance is not doing its job, right? Like, to go back to junk equities, like the great thing about junk equities is that it funded all of these upstart companies that the rest of Wall Street was not going to fund. And right now, Wall Street is not funding small companies for all different reasons, regulatory reasons, and because the IPO process has gotten way too expensive, or for whatever reason, Wall Street is not funding new experimental stuff. And crypto has a chance to be a financial system that will fund anything. And
Yeah.
there's lots of evidence of that, especially lately. Like, there's the protocols for tokenizing IP and tokenizing content, and there's a new one called Believe app, where it's like you can just respond to a post on X, and it automatically creates a coin that is sort of like junk equity representing that idea. Um, like, these are just wild experiments throwing spaghetti on the wall. I'm sure none of those things that I just mentioned are actually going to work. But at least, we're experimenting, and that has a lot of value.
Yes, exactly. And does some of your answer also feed into this term and concept, of the DIY finance? Or can you quickly maybe explain this as
Oh,
well?
right.
What you
Yeah.
meant
Yeah.
by
Yeah.
this?
Do it yourself finance. Yeah. I think there's just another appeal, or another aspect of its appeal is that, it's more manual. Like, uh, you can buy a token and then you lend it out, and you can borrow against it and buy more of it, and you can stake it, and there's different things you can do. You buy a stock, then you're done. There's nothing else to do. All you've done is bought a stock. But in crypto, you are probably a customer. You're probably using the protocol that you've bought a token in, and you can lend it to somebody else, and you can use it as collateral to
Yeah.
borrow something, and you click all of the buttons yourself. Even just that, like, even just having, your own digital wallet, and you do all
Yeah.
and
I,
approve all the
I,
pop-ups and stuff. It just, like, makes you feel like you're doing something, which is more, it's like people need to do stuff. Um,
yeah.
so because
I found it so interesting that you linked it to this IKEA effect, that was
right,
seemingly
yeah,
found in science, right? Like IKEA effect, people like to
yes,
assemble their own furniture, and that's why IKEA really took off probably, and sort of it's sort of
yes,
similar and the same, right? It's very interesting find. I've
yeah.
never heard about this before, because obviously my wife, she loves IKEA as well, and I was always wondering why I can't make sense of this, because now obviously it all makes sense, and it's
Right,
sort of connected to crypto.
gives you a sense of accomplishment, and then you value your piece of IKEA furniture more because you put it together. And I think you could say the same thing about tokens. Like, if you buy a token and then stake it, or whatever, do something with it, then you're going to take more satisfaction in that, and making money
You're
that way, than you are in just buying the stock and having it go up.
Yes, you are your own broker, your own bank, your own everything. So
Right.
that's exactly it. Well, Byron, I think that was amazing. Thanks a lot for taking the time. We've been almost 45 minutes now for the recording. So I'll link to some of the pieces for sure, because I find them really fascinating. And again, I want to encourage people to really read your stuff because it's so interesting, all the historical comparisons that you make every now and then. So thanks a lot. Keep on doing this, and yeah, just have a great one.
Yeah, likewise. Thanks for having me on. I appreciate it.
Thank you. Bye.